Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, if you're wondering how close we are to a real recession, just look at the debt numbers. Today we're going to take a look. Stay tuned for Prudent Money. Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, would like to call into the program, I do have a line open. The number to call is 1-877-913-5357. If you've got a question for me, you can also go to prudentmoney.com. Send a question into the Ask Bob section, and I will get you taken care of. There are a lot of ways to get information. You can start, if you don't want to call into the program, with prudentmoney.com. 1-877-913-5357. So I got a lot to talk about today, and it was just, a lot of it is just coming from observation. And what's amazing to me is some of the things that are going on that are just barely hitting headline news. Let's talk about Russia and China. You know, there's this a legitimate concern of where this war with the Ukraine and Russia leads, and the potential of dragging the U.S. into the situation in literally a World War III. Well, the Russians and in China had a series of meetings, and that they came out of these meetings, and the statement from China is, and it's amazing to me that this didn't get a whole lot of press, but the People's Republic of China is ready to join forces with Russia to decisively stand up for national interests and promote mutual beneficial cooperation in all areas. That did not really make the interestingly enough, didn't really make the headlines. I think that's an awfully big statement, especially considering everything that's going on and happening. You know, one of the things that we talk about when it comes to stock market cycles, where it goes from a bull market to a bear market to a bull market, just think of it going around and around in a circle. And they're real life cycles, and they've been going that way for decades upon decades. I mean, all the way back to the late 1800s when the Dow Jones Industrial Average was actually invented as a stock market index. And there's always something that's the catalyst for the movement down the cycle, bear, which is a bear market, what we're in right now, or up in the cycle, which would be a bull market, which I'm sure most of you are ready for that to come back. And something like a World War III would be something that I don't think very many people would see coming. The markets just kind of didn't do much today. Yesterday, of course, was not a good day, but the NASDAQ was down 0.13%. Dow Jones Industrial Average was down, the NASDAQ was up 0.13%, my bad. Dow Jones Industrial Average was down about 0.25%. S&P 500 about the same. And this is just what happens in bear markets. There's a lot of uncertainty. And a little bit from the Federal Reserve Board, the minutes came out today talking about they felt very comfortable in continuing along with their interest rate policy, which as we continue to talk about, that means rates going up. And rates going up is not good for really anything, the economy speaking, as well as for bonds. What was interesting is bond interest rates, which we've been watching very closely, have had come down quite a bit up until about 3 or 4 weeks ago when they started coming back up again. Now remember, when interest rates go up, bond prices go down, and when interest rates go down, bond prices go up. So there's a relationship, an inverse relationship between the two. And what's interesting is bond interest rates have gone down, which was great for the mortgage market because that meant mortgages were going back down. And we saw interest rates in the mortgage markets go down, I think, to around 6%. Just like that, when interest rates started going back up again, which has been the story of the past 2 or 3 weeks, we have seen, as of today, mortgage rates back up to around 7%. And I got to tell you, it's interesting to watch the activity in the real estate markets. As I've said all along, I think what you're seeing is just a slowdown right now in activity because there's still a supply and demand problem, and that's what inflation is. It's a problem with supply and demand. And I think that you're really, if interest rates start really going up 7.5%, 8%, I don't know what the line in the sand is as far as interest rates go, where it just completely shuts people down. The bottom line is buyers are not going to be able to afford buying real estate at these prices with this type of interest rate that they're having to pay. I mean, you're talking about during the boom where things were just going crazy. We're talking about real estate and the bubble atmosphere that we saw. During that time, interest rates were down in the mid 3s, 3%, the 3% range. Now you're talking, double that. That's a pretty tough jump. And if you were in the market then versus in the market now, I mean, that's a totally different situation. But we'll keep our eyes on that. Mark Pfeiffer, our mortgage specialist, will be on. I think he's due to come on next week. So we really ought to see some movement one way or another in the mortgage rates, and we can ask him what his opinion is. If you've got a question for me, would like to join the program, the number to call is 1-877-913-5357. I'd love to hear from you today, whatever is on your mind. 1-877-913-5357. What's interesting is that I happen to have my phone in here in the studio, and I was reading off what happened today with the markets. And between the time that I was right. I was looking at another screen. Forgive me. Never mind. I'm just talking to myself. 1-877-913-5357. One of the things that is so important about planning, and we're going to be talking quite a bit about that, and something new that I'm going to be rolling out that I think you're going to be real interested in, is when looking towards the future is, you're in a growth mode for most of your life in growing the base of investments to a point to where you enact into an income strategy to make sure that you are taken care of during retirement, just like you were when you were working and getting a paycheck. But this, of course, is an income strategy. One of the investment tips is to look for dividend-paying stocks. And you'll find this in pop culture finance quite a bit, talking about the advantages of dividend-paying stocks. And on paper and in theory, absolutely makes total sense to buy stocks that pay dividends, because if they're paying dividends, those dividends are typically pretty strong, and they continue to pay out no matter what's going on. So even if your stock takes a hit, you're going to get paid a dividend. Except when things like this happen. And this is what you don't get from pop culture finance, is when they don't pay dividends. Intel just cut their dividend today, and the announcement, by 66%. Intel cut their dividend by 66%. Now just think, if you were, as I've talked about, pop culture finance tends to report things as if they're an absolute truth, that nothing's going to happen to these dividends, and you found out your dividend was your cash flow from that made up part of your the dividend from Intel that made up part of your cash flow, was just cut by 66%. And also, I think you'll see some of this as this recession, which we'll be talking about here probably on the other side of the break, starts to move in. Companies cutting their dividend altogether. Now that's a drastic move, and of course, if you're in it for the dividend, you're probably going to sell that stock. So you have some massive selling going on, which lowers the price of the stock as well. So it's one of those things where if you're known as a dividend-paying stock, you don't want to be cutting, much less doing away with. But sometimes companies get into trouble and they have to do it. So what are other dividend-paying instruments? And this is what's been interesting through the years leading up to this time where the Federal Reserve Board started to raise interest rates. They lowered interest rates to zero during the financial crisis, the Great Recession back in 2008, to basically save the economy. They kept it at near zero for way too long instead of raising it up, and then they started to raise it up. And the problem is, and this is worth pointing out, is that we are coming from the lowest place that you can really come from, unless interest rates went negative, which they didn't do, but from zero. So each interest rate hike is necessary to get it up to a normal level, and it takes a lot to get there. And that's why I think that the interest rate hikes this time around are a lot more devastating to the economy than maybe in the past, because you're coming from literally zero versus maybe 2 or 3%. Hey, this is Bob Brooks, 1-877-913-5357. We're up against a break. Stick around. Be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and K. Smith, pastorchuck.org. At pastorchuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at pastorchuck.org, a full library of great teachings by K. Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and K. Smith, pastorchuck.org.
Listen to me. I don't care what you've done, how bad it may be, what anybody has said to you about what you've done. There is no sin that is too great that it cannot be forgiven by Almighty God. Do you hear me?
Dr. David Jeremiah continues his series, Slaying the Giants in Your Life, next time on Turning Point.
9 a.m. here on 91.3 KDKR.
This week on A New Beginning, Pastor Greg Laurie helps us examine the Jesus movement of the late 60s and early 70s, and how the new film, Jesus Revolution, helps us see how to help usher in a similar spiritual awakening in our time. Tune in this week for A New Beginning.
A New Beginning, weekday mornings at 7:30, here on KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show, 1-877-913-5357. I do have a line open, and I would love to hear from you today, whatever is on your mind. We're talking a little bit about where do you get your income from, what makes up your income strategy when it comes to retirement. And so what's been interesting is, with interest rates being increased, this has provided a lot more opportunities and more options. So let's talk a little bit about some of this. Real estate is always an option to be a part of a income strategy. It's just that you've got to be very careful, because there's some of these broker sold type real estate programs and REITs and things like that. They look great on the outside, they pay great for a while, and then things kind of turn upside down. So you want to be real careful about that. Another one that's one of these good things and bad things. It's a good thing if you like them. It's a bad thing if you don't care for them. But annuities, which is almost like saying a bad word sometimes, they've got such a bad reputation. But you can get annuities for over 5% guaranteed, locked in, and for a good long period of time. Those are probably the best, believe it or not, one of the best alternatives when it comes to creating income. I do believe that bond mutual funds one day and single issue bonds will be a good place for income as interest rates go up. So that's definitely, and also, well, not as interest rates go up, prices go down. So once the bonds get through this cycle they're in, because they're in the same cycle that stocks are, I think you're going to see some really good income producing opportunities with bonds and bond mutual funds. So are you wondering how close we are to a real recession? I mean, you can go and listen to CNBC, you can go to Yahoo Finance, you can read articles, everybody's got opinion as to when and where and how big, and a soft landing, no recession. Everybody's got an opinion. And I say you watch the consumer. Specifically, you watch the consumer and debt. Now, what I'm about to read to you, and this comes from, this comes from Wallet Hub, and they do a great job at putting together these special reports. This one's the household debt report. I've been talking about these for years, and I've also been saying for the last couple of years that the consumer, to me, seems like they are financing living expenses. And at the time, that's what you're looking for. When that starts to really pick up to where they're going to a credit card because they don't have cash, they don't have any assets in the bank, maybe they got laid off, maybe the inflation is just taking its toll, and they're financing, at 20+%. It's a brutal place to be, and I think it is a huge red flag that we're definitely heading into a recession. And the reason that that's the case is because 2/3 of economic growth comes from consumer spending. So listen to this, and you tell me what you think. In fact, these numbers, to me, more so than any of the other household debt report numbers that I've talked about on the program, these seem to be more telling that we are definitely heading that way. It says consumers added a total of $398 billion in new debt during the fourth quarter of 2022. That was the fourth highest amount for a fourth quarter in the past 20 years and nearly 4.5 times larger than the fourth quarter in 2021. Now that right there is your telling sign. Total household debt grew to $17 trillion in 2022. Now, Wallet Hub has in their analysis a kind of a line in the sand, which they call their breaking point. That if debt goes above that, that's a really bad sign. It says roughly $1 trillion. They're roughly $1 trillion. Total household debt, is roughly $1 trillion below Wallet Hub's projected breaking point, which on debt levels is based on debt levels during the Great Recession. Wallet Hub has identified the point where debt breaks the consumer, as we're talking about, and you don't want to get close to that point. $1 trillion does seem far away, when in reality we could reach that in no time. I mean, you watch the USDebtClock.org, and you see how quickly it takes to get from 35 to 36 trillion, and it's really kind of horrifying when you sit there and watch it. The average household owed a total of $142,000, $142,680 at the end of 2022. That's only $11,000 below Wallet Hub's projected breaking point for household finances. I don't think this one really amounts to much, but they had a household mortgage debt increased by $290 billion in 2022. That's not a big shocker. And this one is a eye opener. In the fourth quarter of 2022, debt from home equity lines of credit increased by $14 billion. And why I think that is significant is because home equity lines of credit are going to be some of your better interest rate based financing sources, and those look like they have beginning to get tapped. Now here's the worrisome statistic. Prior to the last 2 consecutive quarters, 22 consecutive quarters in a row, this number actually went down. In the last 2, it went up. So for 22 consecutive quarters, consumers were paying down their debt. These last 2, they're borrowing, and that is not a good thing. Auto loan debt decreased by $106 million in 2022. And now I don't think I think that's due to the fact that maybe at some point when you strip away some of the buying, it looks like that they're paying down car debt because there's nothing to offset it. But given high interest rates, short is still a supply-demand issue with cars. I think this statistic is a little bit more worrisome for the automotive industry than the consumer. And we really haven't heard that much about the automotive industry, the effect of all this on the automotive industry. And I gotta think, I haven't really looked at interest rates on automobiles in a while, but I gotta think that those are definitely creeping up there as well, making cars a lot more expensive. It was back in the good old days when you could get 1.5%, 2%, 2.5% for a 5-year, 3-year note on a car. You certainly can't do that today. And then total student loan debt decreased by $83 billion in 2022. That was the second biggest pay down since 2003. I don't know that tells us that much. I'm not trying to not be positive about the positive numbers. It's just that I think that there's going to be a percentage of student loan borrowers who took advantage of this period of time where they were considering, if you remember, President Biden issued a order that student loans were going to be forgiven by, I think, $10,000 or something to that extent. And then the interest and the payments of student loan debt have been suspended since, I believe, mid or so 2020. I still have just, we're reading these statistics now as to what they say about student loan debt, household debt, and I just really have to wonder, as we've talked about with John Hapalo, who comes on the program once a month, what things are going to look like when those student loan debt payments kick back in, and student loan borrowers are going to have to look for that money. That I'm sure it's real easy to rationalize everything when you're faced with a lot of debt, and you kind of look at it. Well, I'll deal with this when it happens, or I'll deal with it down the road, or I'm just not going to worry about it now. I got to spend money on this because I have to. Prices have gone up, so we really haven't seen student loan debt tested by inflation like we're about to see. Lots of things to consider. I think that the most important thing is your own personal relationship with Christ and stewardship, how all that works together, and that's always the main thing. Hey, this is Bob Brooks. If you ever miss a program, you can always go to your favorite podcasting platform. I'm pretty sure we're on all of them. And to go check out the Prudent Money podcast every day. We post in the late afternoon after the program. Hey, this is Bob Brooks. You got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.